This is the London FinTech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman, and this is the London FinTech Podcast, episode 233, brought to you in association with Smart and thelistedboard.com. And I'm delighted to be joined today by Gerald Chappell, founder and CEO of Abound, a credit rating fintech. Now, fintechs doing credit ratings is a topic we've covered before. However, before you all switch off, today we're diving into a fresh way of doing it. Good Lord. And one that, amazingly, Gerald tells me is pretty much uncovered in the marketplace, which is extraordinary. Namely, using open banking data for credit scoring. And by way of context, Gerald happened to be, in his previous incarnation, the global head of digital lending at McKinsey, so he should know a thing or two about this topic. Furthermore, despite Abound only being formed in 2020, last year they raised an eye-opening £500 million in funding, so there must be quite a few people out there who are also impressed by Abound. As to the topic, let's all hear together, as always, I know very little. However, as a noddy level entry point, i.e. my thoughts off the top of my head, if you were to see, say, my last 10 years of banking data and find out that every other week I went into some massive unauthorised overdraft, you might conclude from that maybe I'm not so good with money after all and a quid's poor credit, or vice versa. Anyway, wearing my risk hat, I'm always interested in what signal can be extracted from all the noise in any data stream. And then beyond that, there's the how hard can it actually be to do what conceptually ended up sounding fairly straightforward. Given how rare this is, and I was truly surprised to stumble upon something so seemingly obvious qua methodology that hasn't been mined to death after a decade plus of fintech, I suspect the answer, as always, to how hard can it be is harder than you think. Plenty to talk about, so let's get on with the show. Good morning, Gerald. Thank you for joining me on the show today.
Good morning, Mike. It's a pleasure to be here.
So, with my usual seriousness, or maybe that should be flippancy, in terms of finding a new topic to kick off the episode, I suggested randomly mangoes, and then you told me that in a prior incarnation you'd had a client who was well into mangoes and was telling you the virtues of Pakistani mangoes compared to Indian mangoes and all that. But I don't think I'd be able to hold my end up in that conversation, other than all fruit that comes from Asia tastes so much better in Asia. I mean, I don't like bananas over here, for example, but you go to Thailand and those little bananas are really quite nice. But rather than a topic I know little and you had a conversation about once, you suggested the topic of growing up being an itinerant and moving around this globe of ours.
Yeah, I moved around a lot growing up. So I was born in New Zealand, but I lived there the grand total of 7 months. So don't obviously have a great or like a deep memory of that. From there, we moved to the Northern Territory in Australia. Then we moved up to Singapore, then back to Australia, then up to Malaysia in KL, where I did most of my high school education. Then to Singapore briefly again, where I did some exams. And then I finished high school in Jakarta in Indonesia, which was around about the time of the Asian financial crisis. So back in sort of 98, 99, which was also when the Suharto regime fell. And so that was quite an interesting time to be in Indonesia. I then left there and came to London when I started university. So my father's British initially, and sort of always felt that I should come to the UK for life and education. And so I started university at the LSE in London. I guess that would have been around about 1999, and then I've lived and worked out of London ever since.
We're talking about the weather and how rubbish it had been, and today we've got the second sunny day of the summer for the whole of July and August at this rate. But you, having lived in all these different places, have experienced many different climates. And as we've touched on the podcast before, it's amazing how you can get people from all parts of the world and they actually don't like the weather there either. I mean, Singapore's a tad warm and humid most of the year and not very seasonal in that. I mean, in terms of preferred climate, if you were making Abound's headquarters in the place that you've experienced the nicest climate, where would that be?
I mean, I think Singapore would be pretty hard to beat from that perspective. It's 30 to 32 degrees all year round. Sometimes it rains a little bit more, sometimes a little bit less, but it's a pretty reliable climate. I was actually there 2 weeks ago, so we had our July board meeting in Singapore. We have a kind of mix of European and Asian investors, and so we do one board meeting a year over in Singapore. So I quite like it as a place.
Yes, I mean, first I went there was in the 80s, and there were still parts of Singapore that were a bit rubbish and characterful, whereas now it's all very, very, very 21st century. But yes, generally it's been a bit like Switzerland. Funnily enough, I'm probably the only person in the world that connects Switzerland and Singapore, other than that they start with S. And they're both clean and efficient, and I could never quite see what was wrong with being clean and efficient, and everything works actually, but it was never fashionable to say that. But it does have a different aspect of itinerancy. One thing that I've seen is that a number of people, and I've forgotten who now, but a few years ago I had a guest who had lived in 14 countries. His parents had been diplomats. He was ethnically Indian, but he'd never actually lived in India, for example. I think he was born in Japan and anyway, lived all around the world. So there's a complex question of identity attached to that. But I was wondering whether this sort of moving around thing, although you haven't moved for a while, especially as a young child, programs you to kind of being a bit of a rolling stone, but clearly after 20 years in London, you got over that. And in particular, we were thinking about this recently because a couple of the catamaran channels that we watched and started watching during lockdowns, it seemed very good sort of escapist porn, just buy a boat and go all over the world where the states can't touch you very much at all. Bit of a problem when you come into port because they have to let you in, and in cases like Mexico, it has taken people 3 days literally just to turn up and go through customs. But anyway, a couple of the families that we watch have got toddlers, I mean, a couple under 3 or 2 under 5s. And we're rather thinking that these children, for better and for worse, will be conditioned perhaps for the rest of their lives somehow to keep moving and getting itchy feet and thinking, oh, well, this is nice, but let's move on. I mean, presumably you've found a way of conquering that, or you never actually had that vibe.
I mean, I traveled a lot with work, so I was based in London, but prior to setting up Abound, I used to be a partner at McKinsey, and before that in other management consulting as well. So you spend a lot of time traveling. When I was at McKinsey, I practically lived on an airplane, so I had a global role. I was spending sort of a week in Asia, every other week in Asia and the other week in Europe. So you kind of satisfy some of that wanderlust a little bit through that. But I think, if I had to look at what did that kind of upbringing give me in terms of character flaws or traits, I think some of it was a lot of curiosity. So you're always interested in new things, exploring interesting ideas and so on. I think that's probably why I ended up staying in consulting for so long, because you're always getting involved in what is the new topic, the new issue, the new problem. And that's a little bit, I think, also why I got into founding, Abound and setting that up. Just a lot of curiosity and kind of recognizing that the current credit scoring system is actually quite broken and could be done significantly better if you attacked it in a different way. So maybe that itinerancy leads to a kind of deep curiosity, which then leads to you trying and wanting to do lots of different things.
Interesting. Yes, it's a kind of novophilia. It's a love of the new, which I've always kind of had, but I had a sort of geographical stasis, although vice versa, after far too many decades in this darn country and its rubbish weather and its rubbish politics, I've definitely got the wanderlust about wandering off to some of the nice places that you've been. But not many places actually have open borders, and Bridget and I can't really turn up anywhere, knock on the door and say, oh, we're going to live here or anything like that. So the choices are actually limited, vice versa. Now, you mentioned the career journey, so maybe you'd just like to tell us how you ended up at McKinsey, which you mentioned, and then what possessed you, and I don't know your domestic arrangements, but whether you had to sell the case to a partner, which is the case that, look, I know I'm earning sort of gazillions of bucks every year at McKinsey, and you're buying a new Porsche every week, but how about I go and do a startup? Because this seems far more rational or slash fun. But anyway, you started at university, and then what happened next? How come you ended up in consultancy?
So I started at university. My first job was in energy trading, but I got fired from that before I even started. So when I was leaving university was the time of when you had the kind of the collapse of Enron and the fallout from that. So the bank that I was going to work for basically shut down their energy trading desk. And while I was on holiday, having done all my exams and getting ready to start, I got a phone call saying, oh, by the way, you're not starting anymore. So that was a bit of a shock. And then went from there into strategy consulting. So I started for a small strategy consulting firm, but always with a very strong bent on analytics. So that the firm that I worked for had a real focus on basically econometric modeling. So the economics and the macro environment dictate the business strategy. And so it was a very kind of analytical start. So basically taking my economics degree and doing a lot of work from an econometric modeling perspective. And from there, transitioned into financial modeling and risk. So spent a lot of time as a consultant working with large banks globally on building their risk models. So running up to the first financial crisis, there was obviously a lot of stuff around there in terms of risk transfer and securitization and structured product packaging. And then beyond that into capital optimization, pricing, and just general decisioning risk analytics. If you look at my background, I've probably worked with almost all of the big UK banks, many across Europe, many in Asia as well, on their decisioning models and their credit models across both retail and corporate and commercial lending. And I guess from there, sort of really built this this recognition that traditional consumer credit modeling was actually fundamentally broken. It was based on an entrenched sort of credit scoring system that really hadn't evolved much since the 1980s. That was really just looking at for customers, well, what is the historic credit they've been approved for in the past? Can we apply some basic logistic regression to that and use that to predict credit outcomes in the future? And it kind of works. It sort of gives you something that may be right on average, but in reality is wrong in every individual case. And is quite simple. It doesn't know how much a customer earns, how much they spend, what their affordability situation looks like. And so it's really, really quite limited. And so I guess the last couple of years I was in consulting, I sort of was possessed of this idea that actually you could do this a hell of a lot better if you could just take customers' bank transaction data and really understand their financial situation and use that as the basis for doing consumer lending decisions. And it was very frustrating, just the pace at which the banking industry moves. I felt like it would be an uphill struggle to work with clients to get that in place over a 5-10 year horizon, and it would actually be much better to just go out and do it myself. And so with a partner, a colleague of mine for a long time, Michelle, we set up Abound in 2020. To your question, like, was this a hard sell on the domestic front? It was a little bit.
I know you've been shopping at Harvey Nichols, but we're now going to be eating grass for a couple of years. But we will make a profit after that, don't worry.
Yeah, it sort of went from, it maybe not as extreme as you portray. So I wasn't buying a Porsche every week, but I was very comfortably compensated. And going from that to basically earning nothing, or literally earning nothing. And then at some point we did start paying ourselves salaries, but at a small fraction of what I previously earned. So, I had to convince Susanna, my wife, that this was actually a sensible thing to do, and she was quite skeptical. I think she might still be a little skeptical, but we kind of said, well, if I don't do it, it's something that I wanted to do and had an itch to do for quite some time. Then I always sort of think back and say, well, what if I'd given that a shot? And given what we've achieved so far, so we've been running for 3 years, I guess. We started in, kind of around about mid-2020. I'm pretty pleased with the results so far, and I think Susanna's maybe coming around to it as well.
Excellent. Well, having fairly aged parents and having had sort of a number of health issues with them and a number of issues with the health system in recent months, it brings home to one that life seems, when you're relatively young, to go on forever, but it doesn't really. And if you don't do things when you're alive, it's a bit too late afterwards, actually. And I too have always found that it's not so much a question of regretting what one has done. Well, everybody does stupid things. You think, oh shit, I shouldn't have done that. Sometimes with sort of decades hindsight or something like that. But actually, the things that when you're sitting in your rocking chair on your porch that you kind of regret is all the things that you wanted to do and didn't. Thinking back to it when I was a relatively shy boy from a boys' school that didn't know one end of a girl from another, I think back, oh God, I should have chatted her up. It's the shots on goal you never even bothered at, rather than the ones that you sort of hit the crossbar or you missed. So bully for you in terms of diving in and giving it a go. And before we dive into the main course, or maybe this is actually quite an interesting preamble to the main course, as you know, and I think that Lord King and John Kay wrote a book on this, in terms of what risk is, there was this debate in the, 20s, 30s, between Keynes on one side and people who thought you could put numbers together and the numbers will tell you something, which is clearly what you're very good at. And then the other side, and it's a kind of left brain, right brain thing, this in Ian McGill Christian terms. On the other side, the future's unknown. I mean, A prime example of this have been the sort of the whole lockdowns and the impact of that on credit ratings and everything. It just totally comes out of the blue. Or when the ECU or what are the EMU or all these sort of silly currency systems before the current silly currency system that the Europeans had suddenly broke. You've then got an utter discontinuity. Or like I was the other day, I got a podcast injury. I was walking to a podcast and I managed to trip off a tiny curb and I sprained my ankle, which quite badly actually. Which has confined me to home for several weeks, which again is an unforeseen discontinuity or extremely remote thing. It's happened twice in my life. So, some things of such low frequency you can't really do. So there is this view which I'd summarise, which is in extremis. There's a spectrum or two modes of thinking, which is that, oh yes, we're very clever. We can add up numbers and multiply them and divide them sometimes in our spreadsheet and it'll give a number out and that's the right answer. It's the value at risk or whatever, it's the credit risk. And then the other ones, the other end of the extreme, which says, well, you never know about the future, really. So how do you see that sort of debate actually a century ago now, thinking about it?
I mean, I think the thing that is there will be shocks to the system, and those shocks are always different, and hence, almost impossible to predict. So I think rather than trying to work out what the shock is going to be, you kind of say, okay, if a shock does happen, what are the potential consequences of that? So I don't know it's going to be COVID. I don't know it's going to be something else. But I do know if I have a shutdown in market liquidity, if I have people, with higher financing costs, I have inflation, et cetera, what could the impact be? And so the way I look at that is you can model and calculate for the expected. So coming back to your spreadsheet example, you can work out on average what's going to happen. If people with a certain kind of risk characteristic have credit exposure, how likely is it that they're going to default? That's relatively predictable and modelable. And then I think you have to look at shock and stress testing and scenarios to say, okay, and then for the black swan events, the kind of the big disruptions, how would I perform in something like that? Even if I don't know what the trigger of the event is, is my business, are my finances resilient to a big shock?
Yes, I mean, I agree. And my answer is to that question, which I've thought about for a few decades, is a simple one, which is, look, this is what's happened in the past. This is the data we've got. From this, a mathematical calculation says that. A lot of the time, this is going to be really useful, and some of the times it won't be. And then the other point, which is very relevant to making decisions, you mentioned stress tests. I can't hear that without wincing. After the Federal Reserve managed to get all its banks through the thing by not modelling a significant rate increase in interest rates when they were next to zero, and it's bound to happen. So there is that. But putting sort of rubbish stress tests to one side, there's the unknown unknowns, which always catch one out. And then there's also the thing, which is that, a bit like in life, businesses would not continue if they looked at the extreme downsides. Every business can be blown up. Every person's life can be blown up. And so, what I found when I was literally inventing the idea of stress testing in the 90s, because these phrases didn't really exist, was you show the board the stress test and they go, oh shit, right, we'd all be bust, right, oh, okay. And then everyone will look at their shoes and mumble a little bit and then decide, oh, well, you've got to carry on regardless, because in extremis, I mean, Bankers Trust is a good example. Bankers Trust blew up because serial correlation went to something they'd never imagined, and they were very mathematical at the time. So, yes, there is this sort of dichotomy, which is even if you do, as you say, which is the correct thing to do, from a management perspective, if you spend too much time looking into the pit of doom, I mean, just take it on a life level, if listeners think, what's the worst thing that could happen for the rest of this year to me? You end up dead.
I could walk out of my office today and get hit by a bus, right? But if you run your life on that basis, then you're never going to leave the office.
Exactly. So it's the same. It is the same, I think, in credit and in risk, which is that even if there were no unknown unknowns, even if the modelling of everything was fantastic, if you present, and then the extreme downside is this: people are only going to have to look at their shoes and go, oh, well, we're going to carry on and keep our fingers crossed at the end of the day. It's a bit like the Roman emperors who had that chap following them saying, remember you're mortal. And I mention that simply because we're about to dive into numbers, and I think the important thing for listeners who haven't had exposure to this area is that, look, yes, get the best numbers you can. Yes, get the best modelling and people like Abound to give you it. But at the end of the day, it's a number. And a lot of the time that's going to be really useful, and you don't know tomorrow sometime. But on the other hand, even if you did, a lot of the time you couldn't do anything. One
very quick thing. I think there's the model and there's the data. And you can always make the model incrementally better. You can move from a kind of logistic regression approach to a machine learning approach. There's lots of things that you can do. But if you don't put new data into the model, you're not necessarily going to get any better outcome. You're going to get a marginally better, better trained outcome. But the data is the thing that really drives the power of that. And if you come back to our business, why is it that our approach to credit scoring is fundamentally better? Well, it's because it's using data that's so much more relevant and better. It's looking at the data that reflects someone's actual financial life, all of the bank transactions that they have, rather than a very summarized view of data. What credit facilities has someone been approved for in the past?
Yes, and that also leads on to a different aspect about the realpolitik of this, which is that in practice, you also have another dimension, which not all banks do perfectly well, shall we say, which is the speed of response to changing signals and changing data, which is that. It's like the same old thing about, if you're being chased by a tiger, it's not a question of whether you can outrun the tiger, it's a question of whether you can outrun your mates who you're with. And the same thing in banking. And coming back to the use of technology such as yours, and I always see it as multiple dials on an aircraft. If you're flying the aircraft and something's going a bit wobbly, then some organisations are quite slow to change course, should we say, and others aren't. So there's definitely a competitive advantage there in terms of, as a client, let's say for the sake of argument, I sign up and I take your data, and the bloke next door does the same thing, but I'm just slower to respond to the increasingly red flags that are coming through, and he's faster. He will outperform. So there's also on the client side as well. Okay, so let's go back let's go from the philosophical thing down to the practical. So let's just dive into the sort of simple question then, which is when we were speaking before, I was saying that it always gets hard to find a topic, but in your case, you completely surprised me by saying amazingly nobody's really done this. So why is that? Is it hard after all, or something, keeping it simple?
I mean, I think the thing about a radical idea is normally they're just common sense, and the thing is the rest of the market hasn't caught up to it. In the case of what we're doing, it is actually quite complex, and I think if I look at it, there's probably 4 reasons that banks haven't really banks and a lot of the traditional lenders haven't switched to doing open banking or bank transaction data based underwriting. I think number 1 is it's a lot more complex than it sounds, and we can, if you want, we can really go deep on that and go through all the steps that you need to do in order to be able to extract signal from the noise of bank transaction data. I think secondly, the banks have a lot of institutional inertia, which makes it very difficult for them to move quickly, particularly where they're looking at fundamentally changing a core product. You've got to get on board the business, you've got to get on board the risk guys, you've got to get on board compliance, you've got to get on board all the IT and technology guys, you've got to get on board analytics. And actually, there's a lot of people that you have to say, okay, we're prioritizing, we're moving ahead with this now, and we're going to make a significant investment. And it's even more complicated for the big banks because they have this huge technical debt overhang from their legacy IT systems, which makes it very, very costly. I think number 3, I would also say that across the industry, there's probably quite a lack of vision that things can be done differently. And in a way, you have to show people that things work differently before they start to switch and change the way that they've always done things, or certainly been locked into doing things for many decades. And for example, when we started this, when we were initially saying, okay, what we're going to do is go out and take bank transaction data from all our customers and use that for doing credit underwriting, there was a huge amount of skepticism. People said, well, look, customers will never share that data with you. Why would they? Once you have that data, it's really messy and noisy. You'll never be able to extract signal from noise. So I think there's sort of this lack of vision combined with this sort of healthy dose of skepticism. And then I think finally, reason number 4, and I think this is the worst of all the reasons, and I wouldn't ascribe this to everyone, but it's certainly in the market, is I think some of the lenders just don't want to know. So they don't want to know what's in the bank transaction data because there would be consequences that they might have to act on. So for example, if you have a customer who's got a great credit score, but they have, they're experiencing, a problem gambling, that, it would be irresponsible to lend to that customer. And so if you know about that, you really shouldn't do it. So I think there might be a fear from some of the lenders that would actually reduce their origination volume. The reason I think that's the worst possible reason is, one, you shouldn't be doing that kind of lending. But secondly, actually the upside is, from a lender's perspective, is far bigger because you're able to now properly understanding customers' finances, you can serve a much wider addressable market. So the swap set is like for every one customer that you would decline because they have a prime credit score, but you find some vulnerabilities in the bank transaction data, there are 6 other customers that you wouldn't have been able to lend to otherwise if you just use a traditional approach. So I think those are really the 4 reasons I'd say why banks haven't done it so far. I'm very, very happy to dive into any of those.
Right, okay, so if that's the context, and I think we can take that pretty much as read, given the challenge is not the concept. I mean, to me it sounds, yeah, of course, sure. Yeah, get the open banking data on Mike, work out what you can. From my perspective, maybe I'll even get a better price as a result of sharing my data, which is an incentive for me. But let's just take the simple Gdanken, which is I sort of email you over on a spreadsheet or two, because I don't like these open banking buttons. Technophobia. And you've got 10 years of daily transactions from Mike.
Yep.
What categories of signal are you looking in there? Do you end up with 1,000 metrics or just one? How often he goes bust, or something in the middle?
We end up with thousands of metrics that we pull out of it, but in reality, they don't all have an equal weight. I think at its core, what you're trying to do is say, if I'm looking at Mike, what does Mike earn? What does Mike spend? What's left over at the end? What's Mike's core structural affordability? So you're saying, does he have the ability to repay debt? And then what you're looking at doing is extracting a whole bunch of signals about willingness to behave, to repay and financial behavior that you can pull from that data as well. So you can see things like, what is the velocity with which Mike spends available discretionary income? How stable are Mike's finances? You gave the example before of going deep into overdraft, once every month or something like that. So you start to pick up those things. You can see patterns like, do you always make your rent payments on time, or sometimes do you make them a little bit later? What is the stability of your income? Is it a monthly salary, or does it fluctuate quite a bit, and how do you manage those fluctuations? So that there's this huge number of signals that you can pull out. Some of them are very traditional. So we obviously calculate things like debt to income ratios and debt service coverage ratios and that kind of thing. But instead of doing that based off statistical averages, we're doing that based on real accurate assessments of affordability. So your average bank is going out there and they use something in the UK Office of National Statistics data, which basically gives you almost like not even a postcode average for expenditure. It's just sort of across 11, 12 regions of the country, what on average do people spend on rent, on groceries, on commuting, etc. in each of those areas. And they use that to say, okay, so this is the customer's spending profile. I combine that with what they told me on the application form as their income. I work out their affordability. I can calculate debt to income ratios. I can calculate debt service coverage ratios. But those things are obviously, they might be right on average, as we said before, but wrong in every individual case. So we use the power of accuracy and granularity to do much better in calculating those kind of metrics.
Interesting. Well, going back to my sort of noddy level understanding of anything. So what happens is I send you a spreadsheet, and let's say for the sake of argument, you're sending me all the results and see if I can lend to myself. Then I get basically a chart with about 1,000 lines, which are sort of monthly rolling averages over the last 10 years of a number of these metrics that you say. And then, so just on that little Gdanken, so my spreadsheet comes back, page 2, there's one chart with 1,000 lines on. I go, right, okay, blimey, that's a lot of information. So how does one then consolidate all of these various measurements over time into, let's just keep it simple for stupid people like me, he's a good credit rating, you can lend to him, he's a bad credit rating, you can't. So we'll just do the unnuanced thing first.
Yeah, so we have a kind of what we call a machine underwriter. So it's an AI trained underwriter that basically goes through all of that data. And what it will do is it will come up with a recommendation. It'll come up with what we call a probability of default. So how likely is it that Mike will default? And it will also compare that against the credit bureau's assessment of how likely you are to default. So say, okay, your credit score might say you have a 10% likelihood of default, but we think you have a 2% likelihood of default, actually understanding your financial situation. What we then do is, so in some cases, we make automated decisions. In some cases, we'll ask underwriters to review those decisions. And if you take it's pretty easy to think about one of the ones we ask an underwriter to review it. The model will go through and say, okay, this is my overall recommendation. Of the thousands of features that I've looked at, there are 6 features that are really important in Mike's case, and I'll highlight those for you to take a look at. I will tell you what are the if there are any other warning signs or potential policy breaches that have come through, and I will give you a rapid summary of Mike's financial situation. So here's his top line affordability. We think his average income, his core spending, his financial commitments, his discretionary expenditure, and this is what's left over that could be used for debt service. We'll look at the stability of his income. We'll look at a kind of financial stability profile that looks at how stable and repeatable and reliable the kind of the financial performance is. And we'll look at some of the kind of the balance sheet information as well. And so we're able to kind of summarize that up in what is actually quite a simple package to go through and navigate. So if we present one of these cases to our sort of human underwriters with all of this recommendation and guidance, it takes them about 10 minutes to go through and review and either confirm a decision or overturn it.
I see. And one of the many omissions in the podcast so far is that I ought to have clarified whether you are a fintech, are you selling banks technology which gives a number, says might get 7 out of 10, or whether you're a lender yourself, a fintech, whether you're using your clever computer inside to decide whether to lend Mike money or not?
We were actually both. So when we started off, the vision was we wanted to be able to provide this credit technology platform that would be a fundamentally and different, new way of doing credit, consumer credit decisioning. And our kind of ideal state of the world was every lender everywhere would use that. That would improve access to low-cost credit, and obviously it would be a profitable business for us, sort of providing, being the kind of leading provider of this new way of doing underwriting. But we also kind of realized at the very beginning that no one would believe us that it would work unless we could prove it. Coming back to the point we made about vision, and all the roadblocks that people throw up about saying, something like this will never work. So we actually started by launching Abound as our own consumer lender. We set up the business in sort of mid-2020. We got regulatory approval as a consumer lender in the UK and started lending in March 2021. And so we've been lending for a bit over two and a half years so far. The performance on that has really proved the technology. So we are getting about a 70% reduction in defaults versus the kind of the market expectation, if you like. So for every 10 defaults that our competitors would see, we would see 3 like for like, serving the same risk profile. So we've shown that this kind of open banking or bank transaction data led underwriting really makes a massive difference and also expands the customer base that you can serve quite dramatically. And then alongside that, we have another proposition that we call Render, which is our software as a service offering, where we basically take that lending technology that we've built and proven off our own lending, and we provide that for all consumer lending asset classes. And so we really launched that to the market at the beginning of this year, and that's been growing very, very rapidly.
Oh, interesting. Well, it's a commercial conversation off the topic of how you actually extract signals from this data, but it will be an interesting idea. Let's say, for example, in 5 years' time, you've got 2 divisions and 2 CEOs below you, one of the software division and the other of the lender division, and those CEOs turn up one day and you all have to have a big sort of powwow about, look, what of you is going and what of you are you staying? And the lender's saying, look, just raise $1 trillion and we can knock out Bank of America and all these sort of, HSBCs, all these small fry, we can be the biggest bank in the world. And you see your other guys saying, well, it's just better quality of income selling them computers. But anyway, you're not at that point of having to make the decision yet. So in terms of going back to assessing credit, and there are 2 questions that come to mind. You mentioned you've got a very clever computer that's artificially intelligent, as many people do these days. And one of the challenges with that is it can be really clever, but you haven't got a bloody clue what it's doing. Let's say just neural networked itself and it's a black box and it spits out a number. And you say, why is Mike so rubbish? A lot of these systems can't explain themselves very well. Unlike a human underwriter, even if it's cleverer, it's not going to explain itself. That's the first question. Then secondly, having dealt with that, can we go back on to the discontinuities? I've never done lending to individuals or really looked at that. But again, the discontinuities are quite a big thing. So Mike, for example, could have been a partner at McKinsey's and then one day he lost the plot and decided to chuck that in and suddenly has zero income. And forecasting and modelling that, it doesn't matter how clever your computer is, that's quite a tricky thing to model. But anyway, first things first, you've got a clever computer and it gives you the right answer for the sake of argument, but you go, hang on, why is Mike rubbish? How does it explain itself?
Do you want me to talk you through like how we actually take that data and all the steps we go through to get to the conclusion? Or do you want me to focus on...
I was more focusing on the point that you mentioned, which is that I said you've got this on page 2 of my spreadsheet. You've got 1,000 lines going up and down.
Yep.
And how the hell do you look at these 1,000 lines and assess it? And you say, well, you've got a clever computer that uses artificial intelligences, and it does it, and it comes out with the answer. You go, oh, thank you, oh clever computer. And then you say there's discrepancy. Yep. Well, the model is never 100% correct. And we've dived into AI, obviously, a number of times on the podcast. And depending on what type of technique or technology within the so-called domain of AI you've got, it can be more or less transparent why it's, quotes, saying what it's saying.
Yeah. So I think one of the things that really has allowed us to build a model that performs incredibly well is we have it as a very explainable model, and we have reinforcement learning from human feedback built into the training of that model. So when we started, we actually started with 100% of all of our cases having a model recommended decision, but going through manual underwriting. And so what we were basically looking at is saying, what is the model predicted here? Why has it done it? So we have our kind of explainability matrix. So it goes through and says, okay, these are the features that really contribute and we think are important in let's say, Mike's case. And we'd have the underwriters look at all of the granular breakdown information and say whether they agreed with that or not. And where they disagreed, they would say, okay, well, we disagree because you've missed out the following features. You've missed out the fact that, actually in this case, we can see that Mike's current account balance is almost always zero the whole month. It's only positive for the day he gets paid and the day after, and therefore that's an important feature that you need to build into the model. So our data scientists who sit right next to our underwriters would go away and add that as a feature to the model and go through and retrain it. And we've run this as a continuous iteration since we started lending. We still put a good proportion of all of our kind of proposed accept cases through that kind of manual review as well to continue that sort of retraining. And so if you like, the model has a combination of machine harvested features where it's sort of just going through and doing almost brute force selection of features, and then expert curated features where we've had underwriters go through and say, actually, no, these things are really important in consumer credit. And then you combine those two things and you train it on a series of kind of credit outcomes. And so those outcomes can be, this is what the underwriter thinks is a good case. Those outcomes can be, this is what we actually observed in terms of missed payments from customers in the past. And that continuous improvement cycle is one of the things that's really improved the quality of the decision making. It's also why it's really important to us that it's not a black box model that just says, here's the answer, but I can't tell you why. It's, here's the answer, but let's decompose that into all of the drivers of how I came to that answer.
Excellent. Well, look, we'll come back to discontinuity in a second, but listening to you there, again, summing it up in my ChatGPT, everything as if for a 5-year-old. So the best answer is to get your computers and your people working together and to both learn from the other. And I'm reminded, I was reading last night, not my average reading, but it's very recommended to any tech folk out there, a book called Sunburst and Luminary, an Apollo memoir by Don Iles. And Don Iles was some young thruster back in the day who programmed in near assembly code, really, the landing software for the Apollo space missions. He wrote the whole code and this kind of thing. And right back in the beginning, people would know there was this, the Right Stuff book talks all about this. There was this bifurcation of ideas that on one hand you wanted spam in a can, and the technologists wanted just, look, we flew a monkey, so just tell a human being not to touch anything. Spam in a can, that was called. And the other one was the stroppy jocks, which is you've got the other way, which is that a human can always outperform the machine. But then eventually what ends up happening is that they find the two things work together. It generally went and you will get the computers to do the right thing, but as notoriously known, Apollo 11 almost crashed on the moon, and it was seconds away. They had seconds of fuel left. And I was reading a chapter about this, and it was really sort of fascinating in terms of afterwards, everybody blaming everybody else for this, of course, but it was really vital that sort of Neil Armstrong actually took over for the computer and flew it. And the bug is generally described, and I've seen it previously described as one switch was in the wrong setting. But that's actually a misunderstanding, i.e. they're blaming the astronauts. Though if the switch was in the right setting, it would have been okay. But really, it was incredibly complex interrelation between hardware and software and operational procedures and changes at last minutes and all this kind of thing. Anyway, long story short, that was just a digression, which is that even back in the 60s, which is quite a while ago now, this whole sort of technology versus human being thing turned out to be the right answer. And Apollo 13 was another notable example of where if you can somehow, and I'm simplifying it, but of course doing this well is an art in itself, get the computers and people to learn from each other. It's better. Sunburst and Luminary. Anyway, it's on Apollo. Okay, so I get that. And then, look, so in terms of consumer lending, it's the discontinuity thing. It's the discontinuity of phenomena. COVID comes along, or 2008 comes along, or the market crash comes along, or interest rate spike comes along, or one day Mike, who's been earning $1 million a week as a partner at sort of McKinsey, loses the plot and goes off and earns nothing. So, and this is not necessarily a thing about your approach in particular. It's a generic thing to do with consumer lending. And I mentioned the stress testing and all these things in extreme cases in more B2B things, and that's a little bit different. But with individuals, their individual lives are much more discontinuous than, say, I don't know, the life of a Citigroup or an IBM or a McKinsey who tend not to have sudden changes or sprain their ankle or end up in hospital or ill or this kind of thing. So maybe it's not a specific question to your methodology, but how does this whole discontinuity thing go through your mind when you're awake at 4 o'clock in the morning worrying about it?
So I think we're able to deal with that discontinuity much better than a traditional lender because we have real-time information and we have accurate granular information that points to fundamental risk drivers as opposed to high-level correlations that you have from traditional approaches. So let's take each of those in turn. If you look at sort of the real-time information, take me, so I used to be a partner at McKinsey, and then I stopped earning any money from McKinsey and started a startup. If I applied to Abound for a loan, what you would see is the McKinsey pay coming in and then stopping and then nothing. You wouldn't see that in a traditional credit score. On a traditional credit score, you would just see the credit facilities I'd had in the past, my mortgage, my credit card, etc. And so you wouldn't see any difference. The only way you would know how much I earned is what I said on my application form when I kind of disclosed that. And so likely a traditional lender would just sort of wave that through, whereas we would say, hold on a second, it looks like there's been a big structural change in your finances. We're at very least going to put that into a manual referral queue for someone to take a look at. And so we kind of significantly outperform because of that real-time information. So job losses, payment shocks, significant increases in recent borrowing and so on, all of that you can see from the bank transaction data far before it would start to percolate through into a credit report or a traditional kind of credit file set of information. The other thing then is also fundamental risk drivers. So in a traditional approach, what you're doing is trying to build a correlation between, well, if Gerald's had a mortgage for 5 years, it's unlikely that he's going to default now. And obviously that kind of thing works well in a steady state, but gets fundamentally shifted in a dislocation. So at the moment, interest rates have gone from 0 to 5.25%. Then that's a dislocation, and actually that kind of historic prediction might not be that accurate in the future. Whereas what we're doing, we're looking at someone's granular financial situation, what they earn, what they spend, what's left at the end, all the breakdowns of that financial behavior. That gives you a much better kind of basis to go through and understand, actually, I think, I can understand if this person is likely to have payment difficulties or not. And you might think as a borrower that sounds a little bit negative because you're finding more reasons that you can decline lending. But actually, what you're doing is you're finding more reasons that you can accept people, and actually that's far bigger than the more reasons that you can decline lending, because most lenders in a dislocated environment say, well, there's a lot of uncertainty. I know my models aren't in truth actually really good, so I'm just going to really rein in lending appetite. Whereas what we can do is look through all of that and say, actually, despite all this uncertainty, despite this dislocation, I know that Mike's situation is actually quite stable, and we're very happy to serve Mike as a customer. So it comes back to you can make fairer and better decisions if you've got more granularity in the information.
Yes, indeed. And I should fess up, of course, to bowling a short pitch ball there, because some things like somebody changes career after 20 years is unforecastable, perhaps even for his wife. To a certain extent, if the wife can't do it, a computer definitely can't. And in practice, I mean, it's a long conversation, but what I found by just monitoring P&L streams from whatever it was, 200 businesses in Kleinworts back in the day, and then using that approach for other merchant banks who bought my softwares, is that, yes, there are these kind of things where you suddenly change job. That's a digital, and let's say for the sake of argument, unpredictable. But that isn't the general case. The general case is much more like a seismograph, which is like the volcanoes in Iceland. If you've got a seismograph, it starts wibbly-wobbling before it blows its top. So there are lots of pre-shock leading indicators in the data, and I think the key thing you said is real-time data. Look, if you're looking at real-time data and Mike's bank balance and spending every day, you can be the first to see that he's taken up gambling or something like that. So yes, so my question was a slightly unfair one in taking extreme case, and I just wanted to mention for the listeners' benefit that this sort of pre-shock thing that you often see signals before a discontinuity. Right. Okay. So look, we could keep talking about this for way more than we have, but I hope we've given listeners a real flavour for this area and the richness and depth that is there. And I certainly, if I was a listener listening to this and I was in consumer lending in my bank, I'd be thinking about checking out Abound before they decide that actually they're going to raise $1 trillion and wipe out all banks in the world and benefit in the meantime. And also for a consumer, I might check you out and see what you're going to lend to Mike at. Probably about 15% per annum. Okay, so before we wrap up the show, I'd like to thank all the listeners out there and my brand partners of the podcast. Smart is transforming pensions and retirement worldwide. Their leading-edge retirement tech platform propelled them to success in the UK. Now they're operating on 4 continents and working with partners like Zurich and JP Morgan. Find out more at www.smart.co. Then listedboard.com, your guide to entrepreneurial governance and how you can start making your board an engine of growth today. So, Gerald, that's been a fascinating dive into this topic. I'm still reeling from the idea of getting a spreadsheet back with a chart with thousands of lines on, but at least you've told me that the next page just comes out with a number, which I can understand one number on a good day. So you've been very conscientious in sticking to the main course and haven't told us much about Abound. How many countries are you in at the moment? Roughly how many staffs? Where are you lending? Where are you selling your softwares? What are the plans for the future? And what do you need to be even bigger and better tomorrow than you are today?
At our heart, we're a consumer credit technology company. What we're working on doing is building the future of consumer underwriting. And we think if you look out 5 years, everyone is going to have to be doing this. So, using bank transaction data for doing decisioning for 100% of their customers. Why do I think that? I think, because it just works. You can see that from the performance of our lending. We're getting a 70% reduction in defaults versus the rest of the market, and we can serve a much wider addressable market than your traditional lender very, very safely. And secondly, I think regulation will push it very quickly in this direction as well, because you can't say that you're doing responsible lending where you really care about a customer's affordability, you really care about screening for vulnerabilities, if you're not looking at that bank transaction data to properly understand them, especially when it is so actually readily available now with open banking, PSD2 and so on. So I guess going forward, what is it that we're looking for? At the moment, we are lending in the UK, so under the Abound brand. We're a consumer lender in the UK. And we're looking to continue scaling that up rapidly. You mentioned we'd raised so far about 570 million in funding, so we're very well funded to continue scaling that lending business. We're also a credit technology provider through our brand Render, and we're really looking to be able to take this technology now that we've proven it and roll it out, across Europe to banks and non-bank lenders, and sort of change the way people do consumer credit. We think that will significantly expand access to low-cost credit as you transition to this new approach. And so I think the things I'd be interested in from listeners would be, number one, if you're interested in working for a fast-growing company that's reshaping the way consumer credit works, please reach out. We're relatively small at the moment. We're a company of about 55 people, but we're growing very rapidly. So very keen to hear from people who want to be part of that journey. And then secondly, from a kind of client perspective, if you could see a use for Render and our credit technology in your business to use open banking or bank transaction data more effectively in credit decision making, love to have a conversation obviously about that as well.
Excellent. Well, as I started by saying, it's a very rare area that isn't done before. I had to stifle a groan when you said the regulators will make banks do it. There was this thing back in the day when I started in the city, which is called sort of commercial decisions, and if you made stupid ones, you didn't do very well, and the shareholders were unhappy. But these days, in the Soviet Union and the Western Europe, the regulator tells everybody what to do. And I think the simplest argument of all is, look, you guys have trialled it, you know what you're doing. And if I was, I don't know, CEO of a bank, I'd call the CRO in and say, why aren't you looking at the bloody open banking data? I mean, everybody knows in the world of data, you can't have too much data. You can't have too many, in my sense, dials on an aircraft. So it seems an absolute no-brainer to me. So definitely something that listeners who are after a role in this area should check out, as well as banks who need software and people who need lending. So thank you very much for that, Gerald. It's been a very fascinating one. And as I say, with no idle flattery, it is a very rare guest who's doing something that I hear of that I haven't heard of before once or twice, and having done this kind of stuff about looking for data, for signals in real time, P&L data from hundreds of departments across an organisation, I know that it's an invaluable source of information, and I wish you and Abound and Render every success in the future.
Thank you very much, Mike. It's been great to speak. I really appreciate the time.
Thanks for listening. If you're in need of a non-executive or advisory director with deep expertise, experience and contacts in the worlds of both traditional FS and fintech, or unique insight into how to make your board an engine of growth today, contact me at mike@mikeballiman.com. If you just need one-off advice in these areas, via clarity.fm/mikeballiman.
We could sit in a bender all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moonrise, watching a happy moonrise. Come away from the city, with the tarmac so dead and the people so sad. Come away from the city, with the faces so grey, with the pain of the everyday. We are wild like the mountains and the trees. Can you see what I mean? Can you see what I mean? We fit in between the earth and the sky. Kiss the city goodbye, wave the city goodbye, wave the city goodbye. The city goodbye. Watch the firelight dance with me. 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 Watch the firelight